So, if you're watching the crypto markets, you know what just happened. Bitcoin took an absolute nosedive, wiping out fortunes and leaving a lot of investors completely stunned. In this explainer, we're going to break down exactly how this crash happened, the perfect storm that caused it, and why the old rules for predicting crypto might be broken for good. All right, let's get into it. First, let's just talk about the raw number, the sheer scale of the damage. In just 24 hours, nearly $2 billion in leveraged crypto positions were just liquidated. That is a staggering amount of money to vanish from the market in what felt like the blink of an eye. And to really put that in perspective for you, this plunge means a 23% drop for Bitcoin this month alone. We have not seen a single month this bad for Bitcoin since the huge crypto collapses back in 2022. Remember Terra? Remember FTX? Yeah, it was that kind of bad. This is way more than just a dip. It's a serious rout. So you have to ask, right? How on earth can a price fall so far, so fast? Well, the answer lies in a phenomenon that we can pretty much call the Great Liquidation Wave. This is the engine of the crash, the direct mechanical reason for this insane drop. And that, of course, leads to the billion-dollar question that everyone's asking. What actually triggered this whole cascade? Who lit the match that set off this firestorm? The key culprit here is something called leveraged liquidation. Let's break this down real simple. Imagine you bet a friend $10 that your team is going to win, but you actually borrow the $10 from another friend. If your team starts losing badly, that friend who lent you the money might just grab your team jersey and sell it right then and there to get his cash back. Now just scale that up. Thousands of traders are borrowing money to bet on Bitcoin, the price drops, and boom, the exchange's computers automatically force sell their positions to cover the loans. It's a chain reaction, a death spiral, where every sale pushes the price lower, which triggers even more sales. And look, this isn't just a theory. We've got analysts like Martin Rector-Scott from CryptoQuant stating it flat out. He said this drop wasn't driven by people panic selling the Bitcoin they actually owned. No, this was overwhelmingly driven by these forced liquidations on borrowed bets. And the speed of this was just brutal. Get this, in a single hour, 1 hour, over $700 million in long positions, the bets that the price would go up, were just gone, wiped out. And you can see who took the biggest hit, Bitcoin traders. $500 million of that was just them. But really, nobody was safe. Okay, so we've got the how. The liquidations were the engine of the crash. But that's not the why. A liquidation cascade needs a trigger, right? Something has to spook the market to start that initial selling. And in this case, it wasn't just one thing. Oh no, it was a perfect storm of fear. Let's just run through the ingredients of this toxic stew. First, you've got macroeconomic jitters. Weak economic data from the US kind of killed the hope for interest rate cuts. And you know how crypto loves cheap money. Then you throw in some geopolitical shocks, escalating global tensions always make investors run for the hills. Then the big money started to leave. The Spot Bitcoin ETFs, they bled over $1.8 billion in just 4 days. And to top it all off, another massive hack in the DeFi space. $100 million gone, which just erodes trust even more. You see, any one of these is bad news. All of them at once, that's a recipe for disaster. So with all that bad news swirling around, you can just imagine what the vibe in the market was like. Pure fear. But how do you actually measure a feeling? How can you put a number on the collective mood of the market? Well, there's a tool for that. It's called the Crypto Fear and Greed Index. It's pretty cool, actually. It pulls in all sorts of data, market volatility, social media chatter, trading volume, and it boils it all down into a single number that tells you if the market is feeling terrified or irrationally exuberant. And right now, let me tell you, that index is flashing bright red. It's not just fear, it is extreme fear. We're talking a reading below 5. That's not, oh, I'm a little nervous. That is get me out of here now level panic. This is what capitulation looks like. And it's really important to understand what these extremes mean, right? So when the needle is all the way over on extreme greed, it usually means the market's getting a little frothy and a correction might be coming. But when it's buried deep in extreme fear where it is right now, well, historically, that's often a sign that everyone who was going to sell has already sold. It suggests we could be scraping the bottom. Which, of course, brings up a really interesting question for investors. Could all this doom and gloom actually be a contrarian signal? You know the old saying, be greedy when others are fearful? History shows that these moments of absolute peak panic have sometimes been the best buying opportunities, often right before a major rebound. But hey, whether we get a bounce tomorrow or not, there's a much, much bigger story unfolding here. Something more fundamental is at play. A lot of smart people are starting to say that the old rulebook for how Bitcoin behaves, it's time to just throw it out the window. You know the one I'm talking about. For years, everything in crypto revolved around the predictable 4-year halving cycle. It was like clockwork. The halving happens, the new supply of coins gets cut, and a bull run kicks off. But this time around, it's just different. That reliable old playbook isn't working anymore. And one of the biggest reasons why is a huge shift in what the Bitcoin miners are doing. See, it used to be that when the price dropped, miners had to sell the Bitcoin they earned just to pay their massive electricity bills. It created constant selling pressure. But now, they've got a new side hustle, and a very profitable one: artificial intelligence. They can just rent out their powerful data centers to AI companies, creating a whole new stream of revenue. This means they're no longer forced to sell their Bitcoin, and that fundamentally changes the entire supply dynamic of the market. At the same time, Bitcoin's whole relationship with the traditional stock market has flipped. Remember when it was supposed to be a hedge, something that goes up when stocks go down? Nope, it's become an amplifier. There's this metric analysts use called a beta value. Right now, Bitcoin's is 2.9. That means in plain English is, if the stock market moves 1%, Bitcoin tends to move almost 3% in the same direction. It's become like the stock market on steroids, not a shield against it. So where does all this chaos leave us? I think this quote from the Motley Fool really nails it. It frames this wild ride not as a flaw, but as a necessary phase. It suggests that this adolescent volatility is simply the cost of entry for an asset class that could one day form the bedrock of a whole new financial system. It's not a bug, it's a feature of a messy teenage growth spurt. And that really is the ultimate question, isn't it? As the old, predictable cycles just fade away and a much more complex, interconnected market takes their place, is this kind of gut-wrenching, whiplash volatility the new normal? Is it truly just the price you have to pay to get a seat at the table for what might just be the future of finance?